We might as well begin. It's 8 o'clock.
All right, Jim's giving us the official signal. So
if you're here, you're looking for an ARC PLC update, a 2019 grain farm income update, and a 2020 cash rent update. And so those are the things that we're going to do. And Jonathan Koppas and I'm Gary Schnitke, will do those things. Just a reminder, we do have our handouts. If you want to pull those down, those are currently on the GoTo webinar. There's two versions of those, a 2-pager, which is or 2 overheads per page, which is on the right, what you're seeing now, and on the left, a 6-pager. So if you want to pull down the slides that we're going over, you will see those there. And now we're going to begin with ARC PLC. And Jonathan, what do we know about ARC PLC?
I don't know, but I almost have to give Jim a hard time for putting this picture on here as a bad reminder of the spring we had and almost an ominous introduction to the ARC PLC discussion. Well, as everybody knows, the 2018 Farm Bill reauthorized, pretty much reauthorized with few changes, the programs that everybody dealt with in the 2014 Farm Bill. So ARC, Agriculture Risk Coverage, is the revenue-based program, and price loss coverage, which is the sort of traditional target price or fixed price payment program. Those have been reauthorized. That includes both versions of ARC. That's ARC at the county level, which uses those county average yields, and ARC at the individual level, which uses an individual yield calculation but it incorporates all commodities on the farm. So it's kind of a quasi whole farm revenue component. One of the key things that farmers need to be thinking through right now is that you're going to make this decision, and we don't yet have the start date for sign up, but Gary and I were talking about this earlier. Really, at this point, there's no rush. The reality is that this program, when the sign up starts, there's going to be a significant amount of time we expect for you to sign up, for you to think through what these program options look like, where prices are going to be, and that sort of thing. When you do get around to sign up, and like we said, there is absolutely no rush on this. Take the time to see things play out a little bit more. But the key part of the decision this time, and this is probably the most fundamental change from the 2014 Farm Bill, as most of you will recall, in 2014, when you signed up for ARC County or PLC on the farm, you made that choice, and that choice was locked in for the entire duration of the 14 Farm Bill. That is a different setup than what we have now under the 2018 Farm Bill. So the 2018 Farm Bill has a different sign-up arrangement in that the choice you make for the 2019 crop only locks you for 2 years. So the first choice, when you get around to signing up this year, you will be making a decision between ARC and PLC by FSA farm, ARC County and PLC by commodity, covered commodity, base acres on that FSA farm. And that choice is locked for the 2019 crop and the 2020 crop. But beginning in 2021, you can change this decision every year. So when you're making the decision, and again, there's no rush to do that. When you're making that decision this first time, it's a 2-year choice. And then after that, you're on a yearly basis. So it'll give you quite a bit of flexibility beginning in 2021 to reevaluate where prices are, where yields are, what we think these programs will do. So let's go back over just sort of the basics of the program, right? Price loss coverage is fixed price based payment trigger. It is on the covered commodity. It's using base acres. So this is not what you plant. This is a traditional base acre program. Whenever that market year average price, and that's the 12-month national average price for the crop, and that marketing year average will start in September. So next week we'll begin the marketing year for 2019. It'll run all the way to August of the following year for corn and soybeans. It's June to May for wheat. So one of the things this tells us right off the bat is that these payments will be delayed in general because we wait for the market year average price. So the 2019 crop, we wait until August of 2020 to get that market year average price. And then the statute kicks the payment to after October 1 of 2020. So there's a delay. There's always that timing shift. But whenever that market year average price is below the fixed reference price that's written into the statute, and there you see it on the right-hand side of the screen. For corn, it's 370. Soybeans, it's 840. Wheat, it's 550. Whenever the market year average price is below that number, you kick out the deficiency payment that uses the difference between the market year average price and that reference price. And that difference is then multiplied by the program yield. So there's a fixed yield number that's in there. And then you get that on 85% of the base acres for that crop. And again, base acres are not determined by what you planted. These are historic records that USDA has, and they typically do not change.
And they won't change this time. There's no opportunity to update base acres this time. You will have the opportunity to update yields.
But you can update yields, but not base acres.
But base acres are going to stay the same across FSA farms.
Yeah.
Other thing about this, now look at that corn reference price, 370. So market year average price begins, or market year average period begins tomorrow for the 2019 year. If we wait till December, we will have a better idea of what that market year average price for corn and soybeans are. But, if we're looking at market year average prices above 370, you won't get a PLC payment.
Right.
You may get a ARC payment depending on what yields do. So you might as well wait to have a pretty good idea. And this year it's probably more critical than ever, given what we don't know about the yields.
We don't know about the yields. We don't know about prices. And this is why we're saying exactly that, Gary. This is why we're saying there's no rush to sign up, because you want to begin to see where these prices are moving. With all the trade conflict and other problems that we have, there's no rush. But again, Gary's point's correct. You got to be below 370 over the 12-month average to trigger a PLC payment. A key difference in PLC this time around, that fixed price now sits as the floor, and there is the potential. There's what we call an escalator provision that was written into the law this time around, which would allow that reference price to adjust upwards if prices go high enough and stay up that way for multiple years. What ends up happening is they've incorporated that Olympic moving average component that's in the ARC program. They've incorporated that into PLC as a escalator, as an upside. So you never go below 370. The fixed price does not ever fall below that. But if prices go high enough, 85% of the 5-year Olympic moving average could move that reference price up, which would then trigger it earlier. To Gary's point here, that you've got to have to see a 435. You got to see a fairly significant upswing in prices, and it's going to have to stick around for a couple of years before you'll see it change that reference price upwards. Here's a good example. We're using soybeans in this one, and you can see, particularly looking backwards, how that played out when we had the higher prices factored in for a couple of years. Given where everybody thinks prices are going to be, this escalator is not going to be effective going forward. So it really doesn't factor into your decision. It certainly isn't going to factor in your decision for 2019 and 2020, because prices have been too low for there to be any push up of the 840 or the 370 reference price or the 550 on wheat. So we're not going to see this matter. Where this would matter over time is in the out years, 21, 22, 23. If we were to see a significant spike for a couple of years, you might begin to see that escalator move up the reference price. But right now, it's not going to really impact the programs, the payments, or frankly, anybody's decision. And Gary also mentioned there's a yield update option. Again, this is for the owner of the farm, not necessarily the producer, unless you have that authority. You go in and you can update yields on a crop and farm basis. And this is only the yield used for PLC. And it takes this average yield from 2013 to 17. And then we have this national yield ratio that basically factors back down the yield. And really what you're talking about is you get about 81% of that more recent average yield. Now that's something to run, because we've had some pretty high yields the last few years. So it's possible that even with that discounted ratio in there, that you might be able to bump those up. And this is always this is always a simple decision.
Yep, take the highest yield.
If the update's higher, you take the highest yield.
And again, you'll be able to, so if you have a FSA farm, you'll be able to update yields on corn and not on soybeans and vice versa. So your best thing to do is run the numbers and take the highest number. So, and there will be some documentation required to that, likely, and we haven't seen the rules, so we don't know. My guess is that it's not going to be required at the time of sign up, but I would be using crop insurance yields from your crop insurance. If you're in the crop insurance program, just use those yields and it'll make life simple.
And that's a really good point, because one of the things that's sort of buried in this farm bill is a real push by Congress to get USDA, to get FSA and RMA to work a lot closer on yields. And you're going to see RMA insurance data incorporated more and more into these programs. So Gary's absolutely right. If what you report to crop insurance should be what you're reporting to FSA on this, and you've got the yields and the records there, and that's going to be your best way to deal with that. Moving on to the Ark County program. Again, this is largely unchanged from 2014, but we've got a few minor tweaks, if you will, to the program, some improvements to it. One of the major improvements that became a bit controversial in the first couple years of this program is that all payments for Ark County will be made based on the county the farm is located, the physical location of the farm. There was some confusion and controversy last time around about administrative county. And that is not the case anymore. That was clarified in statute that the county of the farm, the county where those acres are located, is the determination for the Ark County average and payments, regardless of your administrative county. The other big changes are on the yield side of Ark County. So again, we're using that 5-year Olympic moving average of the market year average price. So if you think about, again, this revenue program runs historic as a benchmark. You take the last 5 years prices, the last 5 years county average yields, that multiplies into a benchmark revenue number, and then payments trigger whenever your actual revenue number, the county yield and the national average price, falls below 86% of that benchmark. And that's just like it was last time. What we have are some potential improvements to the yield side. So, for example, any year in which that county average yield fell below 80% of the transition yield used for crop insurance, we plug that in, right? So you're improving that yield number. Probably even more of a factor, particularly here in the Midwest, is going to be this ability to use trend-adjusted yields. Because what that's going to do, and we talked a lot about this as kind of one of the shortcomings of the 5-year Olympic average component of the revenue program, and that is that while prices bounce up and down, and we expect that, and a 5-year Olympic moving average kind of smooths out some of the ups and downs, yields we've long expected them to just improve year over year. So actually a 5-year Olympic moving average doesn't work the same. In this case, what we're doing is plugging in the trend adjusted yield component in the guarantee. What that means for Ark County is it's going to improve the yield protection side, if you will, the way the revenue program estimates or approximates yield risk is going to improve, because you're going to be using yields on an increasing basis as the trend adjusted factor, which is a crop insurance piece that many of you are going to be familiar with. We've used that trend adjusted for quite a while. So this is an improvement to Ark County. It's going to improve the yield side of that component, but we're still on the 5-year Olympic moving averages for prices.
The one other thing that's not on this slide that we should probably mention is that they'll be using yields first from RMA.
Yeah, that's a big point.
RMA will be the first choice for yields. NASS will be the second choice. In Illinois, that would mean, and across all of the Midwest practically, RMA will be the first choice for yields. That will begin with the 2019 year. The 2018 ARC payments, ARC program will run with NASS yields yet. Those NASS yields for ARC purposes, for 2018 ARC purposes, will be released soon. Don't be expecting any Ark County payments for 2018 this fall. Do not be expecting Ark County payments for either corn or soybeans in Illinois. There may be a a county with a small payment, but overall, don't be expecting 2018 payments.
Yeah.
We did have one question. When does the PLC yield update take effect? And we believe that that will be not for 2019, but will be for 2020. Again, we haven't seen the regulations yet.
Yeah. And we expect that all to kick in. And Gary, that's a good reminder that the 2018 crop payments coming out this way. Again, that timing shift. So when you're signing up for the 19 crop paid in 20. The 18 crop, unlikely to kick out payments, will be what's calculated for this fall. And again, the other aspect on our county here from the 18 bill is we're using that effective reference price as the floor price in the 5-year Olympic moving average. So it's basically just a plug price. And again, if and here's where we got percentages on top of percentages, get a little confusing. But if the 85% of the 5-year Olympic moving average price that's used as the escalator for the PLC program, should that happen to bump up the reference price in PLC, that will also increase the plug price used in Ark County. So any year in the 5-year Olympic moving average that's below it would be using that higher effective reference price. So that component works across both programs. But in PLC, it's the trigger. In Ark County, it's part of the revenue calculation to get to the guarantee at 86%.
So we have a question. I don't understand how Ark County using trend adjusted yields. Don't they use actual county yields? And we have not had the regulations here released yet, but here's likely how those will be. And this will just work like crop insurance. There will be an actual county yield that will be based on RMA data, and they'll determine a trend for that county. And let's say it's 2 bushels, just 2 bushels for easy comparison. So trends are going up, or yields are going up 2 bushels. So if we have a yield 2 years ago that's 180 bushels, they'll add 4 2 bushel trend times 2 years ago to that, and then use that updated trend adjusted yield in the yield calculation. And again, we haven't seen those regulations.
Well,
yet.
that's in the statute's pretty clear about that. They've got to use the crop insurance yield. Congress directed that. So we're confident that's the case. But just to reiterate that point, Gary, because what we're using in the benchmark calculation is a 5-year Olympic moving average of the county average yield. What the trend adjustment does is effectively move up each year of that based on the trend, so that what you're talking about, instead of a moving average where a couple down years might be factored in, the yield component of the revenue program will be on an upward trajectory based on the trend yield. So there's 2 bushels. It'll be 2 bushels added every year. So that's how that works. It's a great question. And we will be monitoring that piece of it and getting more information out as we understand it better and get to be able to run some analysis.
So one of these days, FSA will release the official rules, right?
Yeah, we expect the program rules to be out in the relatively near future, and we will be reviewing those and adding or making any adjustments to this as we go.
We originally guessed that they would be out by now, but they aren't. So,
and as part of that guess that things would be in operation, we will introduce and demonstrate a program payment calculator for Ark County and PLC.
And we've had a number of questions here. Our farm is located in Vermilion and Iroquois County. What's the best program? Well, we're going to try and answer those questions for you. And again, right now, wait a little while to make the decision, because if you think about 2019 decision, I would be using something like a 360, 370 price, market year average price for corn right now. That may change if we have much lower yields or something. So we might as well know what that price is. And we'll have a much clearer idea of what yields are a little bit later on in the year. So if we know those yields or have a better idea of yields and prices, we will have a much clearer idea of what the 2019 payment will look like. So having said that, we're going to demonstrate this tool, and you will see the estimates we're using right now, and we will update those as we're going through the year.
Yeah, and that's so just sort of building off that point Gary made. So a little background on this. We have been working with the National Center for Supercomputing Applications here on campus. A great group of researchers and programmers and computer specialists here at the University of Illinois. We have, just sort of to full disclosure, we've been using funding from the Gardner Agricultural Policy Program that we run, and we also got some funding from the Chief Economist's Office at USDA through a cooperative agreement. And what we've done is we've invested those funds into this programming effort. So many of you remember the 2014 Farm Bill and the payment program calculator we used. So we have sort of redone this work and started building this payment calculator based on what we understand from the 2018 Farm Bill and what information we've been able to get out of USDA to this point. And so we've been working with FSA and USDA on this. And so what we have is a program calculator. You saw the website. You can search for it. There's a FarmDoc article from a couple weeks ago that has the link and some background information on this as well. And so we're going to demo the tool and just sort of show you what's going on. Now, one of the things we want to caution, or caveat, if you will, is first, this is sort of our alpha release. This is not a final release. We're still building this thing. We're still adding and developing parts of it, and we will have to update. We know we'll have to update a few things. We expect to update a few things when the final regulations come out and when final data is released by a FSA that we can use in this. So what you have right now, and this is part of that point, Gary, this is an opportunity to sort of run numbers and get a sense of it, but there's no rush to get into a sign up. So you can actually tinker around with this, and as we get this into a final release version, come back to it as much as you want. So there's no rush. But this alpha version here is a try it out situation. So like we said, this pre-release or alpha, we're still developing. Eventually this function will go away and you'll be signing up. You'll get an account with your username and password that'll all be secure and protected. And then you'll log into the tool. And this is pretty straightforward. We're really happy with the development work by the team at NCSA, where this is pretty straightforward. So we go select our state, and there's a little pop-up information. Well, we have a question about Vermilion, so let's put in Vermilion. Select your state and your county, pick your crop, and again, you'll see that PLC reference price right here. This is the statutory fixed price. Now, it could escalate given potential for higher prices over time, but we know it will never be below this for corn. And then what you're going to do is pick your forecast for prices. What we have in here right now is a forecast that Gary's put together of where, and again, like any forecast, this is our best educated guess of where prices might go in the next 5 years. So you see those prices listed along here. And what that does is plugs into the model and runs it against the program over 1,000 simulations to get an idea of potential payments, the likelihood of payments. We have right now a high price scenario and a low price scenario, which are really just, as you can see, kind of just plug in numbers that'll put you in a higher range or lower range to give you a sense of that.
And just to give you a feel of what the impacts of those are going to be, high prices above the reference price, so we're going to see much lower ARC payments. Much lower PLC payments, and then 340, the low price, we're going to see much higher PLC payments. So that's just sort of where we're at there.
Right. And then for those of us that enjoy the CBO analysis of things, we have the Congressional Budget Office's price forecast plugged in here. This is from the January 2019 baseline. We'll update this as CBO updates its baseline price forecast. And eventually, we're looking at some features like being able to kind of pick your own prices over time. But right now, we've got these baked in to give you just a rough sense of this. So that's the price forecast. So you're gonna select that here. That's what runs that's what runs the model. And then you plug in your payment yield. Let's go 160. This is your record with FSA. And again, this is something you can update using that factored recent average yields, and again, information there. here's your trend adjustment. So we have built into this our trend adjustment factor based on what we know from crop insurance. If there are any changes to that we will work on as we finalize this. But that will be built into the program calculations for ARC. And then just as a reminder, your ARC coverage level begins at 86%. It is a 10% maximum range. So you're going from 86 down to 76% of that 5-year historic number. And both programs pay on 85% of the base acres. Again, not what you planted, but the base acres for that crop. So once you've entered this information for your farm, and here we are, Vermilion County corn example, you're going to run the model. It's going to take a few minutes to go through all the calculations. And it will produce a series of payment estimates. And as always, we have to caution, these are not guaranteed in any way, shape, or form. These are the payment estimates based on the MYA price, the market average price you see here. And there's all kinds of background information that you can access. So let's just look at 19, right? We would estimate, given a 364 market year average price and an expected yield for the county of 182.3 bushels per acre.
And by the way, that 182 is not adjusted. That's not for the weather this year yet. And as we get closer, we'll have a better estimate of the yield for Vermilion County. So this is sort of,
in fact, you can see this is a trend yield built into it. So the forecast is the trend yield going forward. The trend yield going backwards is what goes into the into the program payment. And you see your price forecast here. So in that scenario, Gary, right, we run 364 MYA and a 182.3 yield average. We would anticipate the potential for an ARC PLC payment of $14.60 an acre per base acre, right? Mm-hmm. Payment acre. We think there's a likelihood of payment about 35% based on the modeled output. By comparison, PLC, we are estimating 39.15 and a 56% chance of that payment. So that's what you're seeing here is our estimates of these payments. Now, if you like to try to understand where we get to that point, there's a great feature here. Again, hit that again. Under this payment distributions, this will show you how so like we said, we run this over 1,000 model runs around those averages, right? The market year average and the average county yield to get a sense of what this would look like. And so this is our distribution over those 1,000 runs. Obviously, the bulk of them are sitting at zero. In that scenario, we would say there's a higher possibility of not getting a payment. And you can see then as you go up in payment, expected payment numbers, where those buckets fill of the 1,000. You can also pull out the zero to see, should there be a payment, the likelihood is that they're going to fall here.
And
higher likelihood, sorry.
One thing to note here is that the blue bars are PLC, and you'll note that there's a chance of much higher payments under PLC. Those scenarios would be lower prices. Lower prices, and you can see we can get some fairly large payments here. Our county is cut off at that 10% of its revenue guarantees, so there's a hard cutoff somewhere between $45 and $68 per acre.
Which is why you also see it sort of fall out here. Yeah. When in all low price scenarios that would trigger payments, they're going to stop. They're going to cap out because this would be 10% of your benchmark, $68.
Yeah. So there's a couple questions here. One of those is I used to take Arc County. However, I will be switching to PLC so that I can take advantage, and we got that cut off, so I can take it. All right. I can't read the full question here, but let me just say that this last time around, many of you took Arc County for both corn, soybeans, and maybe even wheat. This time around, the decision is going to shade towards PLC, and again, it's going to. I would say that most of you will probably be taking PLC. And again, let's make sure that we know what prices and yields are going to be. So sort of start thinking PLC and not Arc County, simply because our prices are near the reference price. And the other thing that's happened is our revenue guarantees on Arc County have come down a lot.
Right. And I think just sort of to go off of that point, again, remembering that that the moving averages have come down. When you make the decision, it's a 19 and 20 decision. So while we've got 5 years, and this is the 5-year life of the Farm Bill, when you eventually get around to going into the FSA office to sign up, you're signing up for 19 and 20. So you want to focus on these years right now, because that is where your decision is going to lock. So just that point, we've got those lower prices built in Ark County. We've got a much lower price scenario around that reference price in the forecasts. Even the high price forecast, somebody asked about that, Gary, maybe we can explain this a little bit. I went and ran the high price forecast. So you're above the reference price in the market year average, but we do show some likelihood of payments. And maybe that's a good way to kind of explain how this works from the modeling standpoint.
Yeah, so when we're saying here we have a $4 market year average price for 2019, that's actually a distribution of prices around that $4. If we average all of our prices over $4, or they would average $4. So when we say that we're expecting a 363 price for 2019, we're really saying that there could be a distribution, or there will be a distribution, and then 363 is our best guess, and some of those prices will be lower than that, some of those will be higher than that. That distribution is based on the information that we have from previous years, so it's based on a historic look at what price changes look like given where we're at the current point in time. So it's a simulation. So
right, and that's a good point. Again, we don't know where prices are going to be, and it's the best way, if I understand this right, it's the best way to estimate. If you fix a price, obviously if it's 363, you've got a 7-cent deficiency, and that's fairly easy. What we're trying to give you is more information around, and I know this always makes you cringe a little bit, but I think of it as the odds. What are the odds here, right? And so this distribution gives you a chance to understand that sort of prices, not knowing what they're going to be, the ability to sort of see this run out over 1,000 different scenarios around that price. So again, and once it's $4, if it's $4 at the end of the marketing year, we know there's no payment for PLC. We're above the reference. But using a forecast, the odds running around the $4 get us this 34% chance of a $17 payment or PLC. So that's what we're looking at. And again, if you hit this distribution, you really see this play out. The vast majority are at 0. 843 out of 1,000 for Ark County, 659. So in 1,000 runs of this payment estimate around $4, 659 of these come out at 0. So that's kind of a good way of understanding, at least in my mind, to maybe a less economics focused mind, that there's sort of the odds of the payment scenario here. And again, you can run this. We've got the 3 major crops in there for now.
And they want to see there's a question to look at the low price scenario. So we'll run a low.
Oh yeah, sorry. We'll do
corn low price scenario.
Again, just run the model. And each time we're running this in the background here on campus with the supercomputing folks, and it's always enjoyable to think about what goes into some of this technology and how it works. So in a low price scenario, running at 340. Now again, if our actual market year average price comes out at 340, we know we're in a 30-cent deficiency situation against that 160 bushel on 85% of your base. So we know that, but trying to understand, the likelihood, here's 340. We're thinking 69% at PLC and even 50%. So this raises the odds of both programs that would trigger a payment at 340 in that high yield scenario, or that trend yield scenario. And again, if you look at the distribution now, a whole lot fewer in the 0 range, and we've boosted the number of potential payments going out. So that's where that forecast scenario works. And that is, again, a lower price scenario. I mean, this is to the point Gary made earlier, right? It's hard to beat PLC right now in 2019 and 2020, given where prices have been and how the Ark County guarantee has adjusted. What we'll really be watching for is what happens the next couple of years and what these out years in 2021, 2022. But right now, given what we've seen, now what could be fascinating is a higher price scenario going in going in from a short crop this fall, how does that begin to change it? So once we have those numbers, we can begin to update this and put in some higher price scenarios. But right now, PLC at 370 is going to be hard to see payments coming out higher in Ark County.
We have a question. Will you incorporate irrigated yields? The answer is yes, we will incorporate irrigated yields in all of those scenarios, in all those counties where that is an option. We also got a question. What impact should the SCO election have on the decision to pick Ark and PLC? And again, as the questioner indicated, yes, you have to take PLC to have SCO available to you. And that option would obviously shade it more towards PLC. I think your decision will depend on where you're at on your RP coverage level. If you're at a RP at an 85% coverage level, the SCO option would increase your coverage level from 85 to 86%. And remember that 1% is based on a county revenue, not a farm revenue. So that has much more limited value to you than if you're taking 80%. So having the SCO option available shades more things towards PLC. Remember, this year you signed up for SCO, have not made your final decision on ARC or PLC, and what you decided for SCO will not limit you to ARC or PLC.
And I just going to highlight, there's a question about irrigated and non-irrigated. So the farm bill tells FSA where there's 25% of the production of the county is irrigated, that county has an irrigated, non-irrigated function. We are building that piece in. So here I just picked a county out of Nebraska where you can see that our data indicates the irrigated, non-irrigated component. That will be an option in the program, but only for those counties. Right, if I compare Banner to Cass, for example, it's only in those counties where there's 25% irrigated or more irrigated production that FSA will have that. So the irrigation piece will be in there as we get to the final release.
We've had a question about ARC IC, and ARC IC is not built into this model right now. We will provide an analysis of ARC IC as we have more of the rules available to us. We believe, and let's be professional about this, we believe that ARC IC for most corn and soybean farmers will not look that attractive, but we're going to wait to hold final judgment again until we see all of those regulations.
A couple of things just to remember on ARC IC. It triggers at a lower. So one of the key things about ARC IC, where ARC County triggers at 86% of the benchmark, ARC IC is at 65%. So it triggers at a much lower level. It's using yields across that whole farm component. And one of the reasons you don't see it in here is because if you choose ARC IC, all of your crops on that farm have to go into the program. So we cannot do a crop by crop comparison on the same way we can do with PLC and ARC County. So one of the reasons we don't have it in there is because it is a very different decision. And like Gary said, we're working on trying to get something put together. Once we have more details on a few items of that program, we'll have something put together to run a scenario on it. But it's at that lower trigger point, frankly, it's a difficult program to compare against these. It's on a different level of base acres. I said that wrong. The trigger point's the same. The base acres are reduced to 65%. Sorry, I mistaken there. But it changes the dynamics significantly. So right now we're at ARC County and PLC, but stay tuned as we work out the details on that.
So poorer yields we have a question. What impact will projected poor yields have this year on ARC PLC 2019 crop year payments? Poorer yields will cause ARC County to trigger more.
More likely
to trigger in higher prices, higher per acre payments. Again, we got to see those yields. So and again, that's why waiting to make this decision is probably a good thing to do. All right, I'm trying to get back to our PowerPoint now.
Yeah, and that's a demo of it. That tool is up and available for anybody that wants to check it out and give it a run and see what you think for your county, your farms, and then stay tuned as we get that updated and finalized. We'll have more information as we go.
Again, we would tell you not to be in a hurry to make those decisions, and we will have more webinars, maybe even on a Friday before a football game. We'll be talking about the undefeated Fighting Illini as we move through this year. We're going to move on from ARC PLC. If you got any more questions or we haven't answered them, please just go through those, put those in our, submit them. We did have one thing. When does this decision need to be made? And it will be a while, right?
Not for a while yet. We don't have the final sign up dates or deadlines at this point. FSA will announce that when they publish the rule for it. But as Gary said, and we've emphasized, there is absolutely no rush. Once that rule comes out, take your time, run the scenarios, see where yields and prices look like they're going, get a better sense of that for the 1920 decision.
So we're going to switch now to 2019 and 2020 farm incomes, and we're just going to give you a feel for where we think those are at right now and where those are going. Just a reminder, the big change that we've had in farm incomes are actually two, but what has triggered most of those are lower soybean yields, and this chart does show those lower soybean yields. You can see the dip there towards the end. These are U.S. monthly soybean prices, and since last May, not this May, but the May before that, we have been below $9. We've had soybean prices mainly with an 8 in front of it and occasionally a 7 in front of it. And right now, I guess we would be saying that you can expect to continue to have 8s in front of your soybean prices for a while. Here's 2019 projections for both corn, soybeans, and wheat. You can see there that soybeans for 2019, we have an 840. This is a projected price based on WASDE. WASDE, the August report, and there they would be suggesting that the market year average price for 2019, which would also be pulling into our PLC decision, would be 840. That happens to be exactly at the reference price. Next year for 2020, this is projections made based on futures contracts, and cash bids now would be 880. And you can see both of those are below $9, and we're expecting those for the foreseeable future. At the same time, we don't see corn prices going above $4. 360 is the projection for 2019. 370 is the projections for 2020. And again, we've had a whole series of prices below $4 since 2013, and we expect those to continue there. And you're going to see here that we're going to come out with a pretty low projection of net incomes for 2019 and 2020. And probably the item that could increase our income projections is an increase in corn price. Soybean prices are not likely, but maybe an increase in corn price because of yield shortfalls in the United States, or those being less than what we expect at this current point in time. Obviously, that would have a pretty big impact on our incomes as well, because if those are expected to be less than we're looking at, that means that yields in this area would be look less than we're expecting. Soybean prices look to be below $9 for the foreseeable future, and that's just simply due to trade uncertainty, African swine fever. Both of those things are a China phenomena, and even if we did get the trade tariff situation resolved, it's highly likely that we would have soybean prices below $9 simply because of reduced demand from African swine fever and our large carryouts. So no matter what, expectations are for 850 to 860 to 870 soybeans for the foreseeable future, and that foreseeable future is 2019 and 2020. So we also have, so prices continue in the 8s. We will have MFP payments this year, and those have been announced. And our understanding is that those should be coming right now, or are they on the way, Jonathan? Or do you know where they're at?
I do not know where they're at. The sign up is out there. The information's on the USDA's website. And what we do know, I don't know when the payments will go out. Obviously, that depends on having signed up for them and all that. It also a reminder that you're only going to see half of that payment this time around. So, and some people, I imagine, if you've signed up, we just got somebody responded. Somebody's received their payment already. So if you sign up, you're going to get it in the relatively near future. Again, half of what is available based on that county payment rate and the planted acres in the county, with a $15 on cover crops.
Yeah, and again, the payment rates in Illinois ranged from $53, that happens to be Joe Davies County, and $87, which happens to be Piatt County. Most counties in the central part of Illinois had somewhere above $75 per acre. So 80-ish is the number we're using for central Illinois. Again, you've received half of those payments. There's not a guarantee that the second and third payment will be, but Jonathan's laughing here. He says that's a sure thing. He'll bet his life on it, right? Or something.
I would neither bet my life or say it's a sure thing, but I'd be real surprised if the other two installments don't make their way out.
Again, those payments, if you compare those payments to what we received last year, in general, if you average what you received last year over what you are going to receive this year, it's going to be about $20 to $30 higher in the Midwest compared to last year. So that $87 in Piatt County is likely to be $20 to $30 when we average that large soybean payment over last year. So this map just shows you that that's pretty consistent throughout the Midwest. And then there's some other counties where we have much higher payments. Those the much higher increases than those tend to be in the South.
Those are cotton counties. I mean, as we look at this, those counties that have cotton have managed to get significantly higher payments than they got last year. For anybody wondering that, that's pretty clearly where that's headed.
So if you're looking at 2018 and 2019 income for Central Illinois, so there's going to be three impacts. Obviously, our prices have not moved up for corn or soybeans. We're going to have a 20 to 30 bushel or $20 to $30 per acre higher MFP payment, but overall, our yields are projected to be much lower, and this just shows our gross revenue projections for corn in Central Illinois. We're coming here with a lower projection for 2019, and that's primarily based on lower yields, and I'll show you our lower yield projections here, and then we move up a bit for 2020. So overall for corn, roughly the same levels as last year, but a significant portion of that increase or staying the same in gross revenue is because the MFP payment, which was $1 last year for corn and is closer to $87 this year.
For corn and soybeans. So you're still across both crops.
Across both crops. Here, and again, we're showing Central Illinois 2018, 2019, and 2020. So these numbers are for Central Illinois. The 2018 number is a summary of high productivity land enrolled in FBFM, 237 bushel yield last year. We're coming in with a projection of 195 this year, and you can argue with me on that. Here's what I'll say. If it goes lower than that, it's not going to impact revenue that much, because what you'll be doing is reducing crop revenue as you lower that yield, but you'll be increasing crop insurance. So it's sort of a switch. That's
at 85%.
85% coverage level, which is where most people are at. If you're at a 75% coverage level on RP, those things are going to be, you're not going to be triggering crop insurance payments. So 195 coming down, and then again, you can argue with me about whether that's the right yield or not, but it's pretty clear to me. I would guess that we're looking at lower yields. You'll see in there crop revenue 722 for 2019. We built in ARC PLC payment of $10, and we'll see that's, by the way, that number will be received in the year 2020. You'll see the 0 number there for 2018, which is what we're expecting to receive this fall. $82 of MFP payment. And here's where we're going out on the limb. 2020, there's a $50 payment in there. That has not been announced. That has not been anything. So this is my speculation. There's going to be another MFP payment next year. I'm building that in there because if we don't build that in there, it looks really bad. Go ahead.
I just want to be clear. That is not the third installment of this current.
No.
So that is another MFP. That would be the third different program, 18, 19, and 20. So that's what you're factoring is yet another round of MFP payments, and not again, the third installment.
Yeah, that $82 assumes for 2019 assumes that you get everything that is occurring this year. Even with those, 2019, you'll see that a farmer return is minus $43 for 2019. That number is way at the bottom here, minus 43. This is after paying an average cash rent of $274. Next year, we're projecting a $13 return for corn based on a $50 MFP payment thrown in there. And again, we got a $3.90 price, $2.11. 2020, if we want to get this number to 0, we either have to have this MFP payment or 12 bushel higher yields than 211. So another year of exceptional yields or MFP payment would get us to 0.
That's at a $3.90 price.
That's a $3.90 price, and you can argue with me. So whether that's the right price or not, that's a bit of a rebound.
So get to break even, you got to have a higher price and a higher yield.
Yep. Yeah. For next year. So given that, this is let's do this for soybeans. Soybeans 2018, you see our revenue here was pretty good, actually. Remember 2018, we had exceptionally good soybean yields, and this was our $60 MFP payment here. 2019 and 2020, we got those gross revenues from soybeans much lower, and in fact lower than 15, 16, and 17. And let me just go through our calculations here. Here's soybean. Again, 2018 is the numbers that we have for Central Illinois FBFM farms, 74 bushel. We're putting in for 2019, and again, you can argue with me, 55 bushel of soybeans, $8.50 price per bushel. If we get lower yields than 55, we don't really impact the farmer return or gross revenue that much. A lower yield decreases crop revenue but increases crop insurance proceeds. Given a 85% RP coverage level, again, we're building in an ARC PLC payment of $10 for 2019, MFP payment of $82 for 2019, and again, $50 for 2020. I've built in here a $9 price, which is a rebound for prices, and that may be a stretch. 63 bushel yield, which is still below our 2018. But we are looking at a minus $65 return here, given those scenario for 2019, minus 8. And again, that minus 8 is built on a $50 MFP. To get us close to 0, we either have to have a MFP payment of $50 or actually $58, or this yield here, 63, has to go 6 bushels up or close to 70. So overall, we're looking at lower incomes here for 2019, and also given those numbers, a pretty low 2020 year. Want to point out here, we also show here what prevent plant will look like. And again, we built in a prevent plant payment of $410, which is based on roughly a 230 bushel APH. you'll see we got a minus 16 farmer return. Put this up here just to make the point that taking it prevent plan. I heard a lot of discussion that was your well, you're going to make money at that. No, you just stop the bleeding at a certain level at that point in time. In any case, here's what this looks like, and we're just giving you a historical feel. The blue line is operator and land returns for corn, soybeans. We come down here, 2018, we were above it. 2019, we're well below it, and that is even with our MFP payments here, and then going into 2020. And 2019 looks worse than any year. Maybe you get close to 2015, but right now we're looking at 2019 to being a worse income year in Central Illinois. What could cause those 2019 incomes to increase? Maybe some help from the ad hoc disaster assistance bill, but that's likely targeted at prevent plant, and that's likely to be pretty low.
I wouldn't bet on that.
Higher corn prices, but that probably implies lower yields and higher crop insurance proceeds and higher yields. In any case, it's not a pleasant outlook for 2019. Which then, so if those hold, we would be looking at, last year we had $120,000 per farm revenue net income from FBFM. This year we would be looking at something below zero, just to give you a feel for what we're looking at right now for 2019 and 2020 with an MFP payment would be at zero.
So just to tee this up, I look at that, and maybe oversimplified, but at the end of the day, looking at what you're talking about, at this point, managing through this mess, frankly, it is a discussion about lowering costs. I mean, the expectation of yield or price improvements at this point are tough to make run. And so it is a cost reduction discussion at this point. Where can I cut my costs to sort of get through this? What is expected at least 2 years now, 2 more years of real struggle on the financial side. Yeah,
and that brings us to probably the only cost that you can realistically look at cutting, and is 2020 cash rents. And so far, what we've seen on the cash rent side is nothing. No downward movement. This happens to be 2019 data for the state of Illinois. So this is averaged over the entire state. $224 per acre was the cash rent for 2019. That actually was up a little bit from 2018 when we had $223 per acre. Our expectations, and we just beginning to get expectations of what 2020 cash rents will be like. Number of people are saying that they expect no downward movement in those cash rents. If we're looking at across the Midwest, the Western Corn Belt probably has higher yields than we do and maybe less income. So those farmers will maybe face less pressure on reducing rents. Whereas here, if we have lower yields, and again, whether a 195 is the right number or not, if we don't get those exceptional yields that we've been having in several years, we will face the downward pressures on cash rents. We'll see working capitals decline during this year. Again, slide shows what the Illinois Society is saying, and they're saying that they expect a $4 decrease in cash rents on excellent quality farmland. That would be something that would be producing expected to produce over 200 bushels per acre. Again, if you're looking at stable cash rents and where we're looking at these returns, again, the 2019 returns will be lower than anything we've seen since 2005, 2006, and another poorer year in 2020. And again, we're a ways away from that. But it's not a happy situation. We will see some pressures on rents. We're looking at declines in we've seen declines in returns since 2013, and people have been getting by during this extended period by having working capital to rely on, and using that working capital to get through that period. Now we're looking at, rather than having that $9 soybeans that we had in 2015 through 2018, $8-ish soybeans, and you saw my projections even with $9 per bushel, that we're going to see much lower returns. So
we reached the 9 o'clock hour, which means we're happy to take we got some questions on the screen, and we're happy to take some questions here for a few more minutes if Jim will let us go a little bit over schedule. So if you have questions, send them in. We've got a few of them here in front of us.
Here's one. Economic theory may indicate that rents should fall, and I think they should. There's still significant competition for farmland. And I would agree with that assessment, that there is still significant competition for farmland out there, and there likely will not be significant falls in cash rents going into next year. That's
a fascinating dynamic, and I know there's stiff competition for acres out there. I wonder if there are other factors that are making those rents, or adding to the stickiness, if you will, of those cash rents. I mean, is there some of this perception of these large payments rolling out on MFP, the idea that, those things, because you're looking at multiple years of a down income, which seems to me would be putting a lot of pressure on cash rents.
Yeah, the MFP payments, the optics of that are probably not the best for reducing or cash rents, because if you look at a payment of $80 per acre in central Illinois, you're going, why do we need to reduce cash rents? The fact of the matter is that we've had more than a $100 decline in expected revenue, simply because of lower prices and lower yields this year. So we have another question. How is the current bond rate below 1.5 impacting the cash rent level? I would bet that bond rate is having more of an impact on our land prices. And here's the way this works, is that if you're looking at land, and land prices have remained relatively stable throughout the last several years, and again, I would expect them to remain stable moving forward. If you look at the alternatives, I mean, interest rates are not rising in this country, and we now have a Fed that appears to be willing to lower those rates, and we also have other countries where we have negative interest rates and negative yields. We have an inverted yield curve in this country, so land, a real asset, that looks pretty good. If you're also looking at the stock market, moving with some concerns about the recession, that doesn't look like all of that good of an investment either. So land being a real asset is a good place to be.
We got a request just to run some soybean scenarios. So I was going to do that real quick while Gary is answering that. Also, a question on rerunning the models in November. I'm not sure. This is running live, so you can run this as we go. We will be updating with new data and new information, so the models will be adjusted as we go. We hope well before November, but that depends on getting the final regs and getting the final data from FSA. But certainly these will continue to be updated, and that's why you've got plenty of time to make the decision, and you can use this. This tool is live and operational, so you can use it anytime you want to double check things or run different scenarios. So we encourage everybody to check back with it as we go.
We had a question. I think your tool favors Ark County for beans and most scenarios, and PLC for wheat and beans. Actually, I think our tool usually favors PLC right now with these price scenarios. With the price scenarios that we're running. We will see where those end up because we want to put the yields in there.
What you will notice, and this is backed up by history as well, that both PLC and ARC are going to make expected far lower payments and less likely to make payments on soybeans. Even in these lower price scenarios, soybeans just have traditionally not triggered the big payments. So there is that. They're certainly closer together in both price runs and percentages. But
and again, look at soybeans. So we're looking at a 386 expected payment per acre compared to corn, which was in 40s and 654. So you're looking at pretty small payments there for soybeans, and Jonathan's running this again.
And here's your low price scenario on soybeans at around an 850. So just to give you a sense of, again, an 850 scenario would be a higher per acre payment, a higher percentage, potential likelihood of those payments for beans in McLean County. But again, you're not expecting, you don't expect much out of soybeans on the payments. And I will run a wheat.
So on the ARC,
real quick.
So one other question we have is on the ARC PLC program decision, who makes the decision on the farm, the owner or the operator? That is the owner.
Right? No, the program decision is the operator. The yield update, remember, it's the operator that's dealing with the farm operation side of it, and some of it may depend on your arrangement with your landlord, but typically it's the operator that goes in and signs up for this, just like that buys the insurance, but it's the landowner that makes the decision on payment yields. And you can always remember this because the decision that sticks with the land, regardless of who the operator is the one the landlord makes. So the operator, and although they can have authority to do this, it's at the landlord's it's because it stays with that acreage, right? You're changing the program record for that acreage going forward.
Is Jonathan betting his life on 2020 $50 MFT payment? I don't think you're betting your life on that. But
I'm betting on nothing in this scenario. I think we are in as uncharted a set of waters as we can possibly imagine. I don't know. I don't know where we go from here.
So we're going to summarize it here. I think we've answered most of the questions. Again, we would be saying probably look at PLC for all three crops, corn, soybeans, and wheat at this point in time. Don't be in a hurry to sign up, though, because we got time, and we might as well. We haven't seen the rules yet, so don't be in a hurry. And we haven't
published it. They haven't started sign up. There is plenty of time. We will update as we go and as we know more information, including updating this tool. So I think that is probably the big takeaway on ARC PLC is there is absolutely no rush.
And how could there be PLC payouts in a high price scenario? Again, we're running a simulation model. So even though we're have an average, there will be some price scenarios where that's below that. One other question, are our yield updates for PLC automatic? No, they are not.
Yeah.
You gotta do that. How will the recent decision by the EPA affect the biodiesel industry moving forward? And I would say it's not a good situation.
Yeah, these small refinery waivers, frankly, have been a bad idea. They are questionable under the statute and regulation. But I think we have to acknowledge that they seem to be trying to work something out on this issue. So we don't have the final details on the waivers, but they have been a problem for the biofuels industry and the biodiesel industry in particular. Looks like we've run out of time and patience
and questions.
Jim's about ready to kick us out. So we appreciate everybody taking time here today.
And root on the Illini tomorrow.
Go Illini tomorrow. And have a good weekend, good Labor Day weekend.
Thank you.